Okay, so thank you to everyone for coming to today's workshop. Just to introduce myself, I'm one of the co-founders of UMA, which is an open source protocol built to enable universal market access. What we're building is really two pieces of infrastructure for the Ethereum community. One, which is a set of smart contract design patterns that you can use to create financial products on the blockchain. And the other is a fully decentralized oracle, so that you can actually value and settle these derivative contracts. What I focus on is typically things on the financial engineering and kind of non non like blockchain related stuff. And recently, we've gotten a lot of interest from people wanting to hear about, learn about, or understand interest rate swaps better. And so I thought I'd host this little workshop to go over it. I'm going to just generally start off by assuming that you guys are all already loosely familiar with kind of the other DeFi lending protocols like Compound and MakerDAO. But if there's anything that's unclear, again, feel free to interrupt and just ask questions, and hopefully we can make this a really good, engaging conversation. So kind of the first topic to talk about is what is an interest rate swap? And really here, in order to explain what an interest rate swap is, it's useful to start off by thinking about what is an interest rate and how do they get determined. So in the context of DeFi, what you would typically see happen is you have a borrower who deposits some ETH into a smart contract in order to borrow something like DAI. And there's all these different basically parameters that are governing the rules here. You know, you have to deposit more ETH than you can borrow in DAI. You're going to get automatically liquidated if you don't make sure that you top up if the price of ETH goes down, things like that. And there's this whole, secondary keeper system that typically runs in the background of all these protocols to make sure that everything's working smoothly. What happens when the borrower repays his loan is the borrower will get his ETH back, and he needs to repay DAI with interest. And this has kind of been a source of some conversation within DeFi recently, because DeFi interest rates have risen pretty dramatically over the course of the year. So I think the MakerDAO stability fee got as high as, was it 20.5% or 22.5% at one point a little while ago, and that was from a low of actually less than 1% last year. So pretty meaningful from the borrower's perspective. If the borrower was trying to borrow that DAI for some use case that he had in mind. And so why do these interest rates change, at all, right? Why can't this borrower just pay a flat 5% annualized interest rate? Typically what's actually happening, and it's a little bit easier to envision this in the context of like a compound pool. You have a pool of borrowers, and you have a pool of lenders. And then you have everyone else. And what's happening really is the pool of borrowers is always shifting as new borrowers come in or as old borrowers pay back their loans. And the pool of lenders really is as well. Some people started off the year deploying their capital into Compound and then deciding later on that they had better uses for their money or were able to earn a higher return elsewhere. At the very, very end of the day, an interest rate is really just the price that we assign to somebody who wants to borrow or lend money. And so just like any other price, it really follows, but even more actually closely, it really just follows supply and demand. How much supply of money is there? How many lenders are there? And how much demand is there for that money? How many borrowers are there? What interest rates do is price that demand. And what interest rate swaps let you do is really trade the price of that demand. And you can even trade the price of that demand in the future. So you wouldn't just look at like what the demand for borrowing and lending is like right now at this instant. You would say, oh, what do I think the demand for borrowing relative to the demand for lending will be over the next year or over the next 2 years? or in 1 year's time for the next year after that. They're really infinitely composable. Like any given lender who's thinking, I want to lend out my money for this period of time, could be matched off against one borrower who wants to borrow short term, another borrower who wants to borrow long term in the future, or really again any combination of those borrowers and lenders. So why does an interest rate swap matter? Because interest rate swaps let you actually trade effectively the price of money, the price of borrowing and lending, both now and in the future. It actually lets you offset risk more efficiently than just straight up matching off borrowers and lenders one by one. So to give you a more concrete example, right? Let's say that I wanted to borrow money in order to pay payroll because I'm a new startup company and I own some ETH. And I don't want to just sell all of my ETH yet, but I do have some expenses that I need to pay out to my employees. Well, that's really probably a very, very long-term kind of projection. I want to borrow that money today, but I'm not sure if I'm going to be able to pay it back in 1 month or 6 months, or really more practically for a startup company, multiple years. If I had to find a specific lender for every loan that I wanted to take out, it'd be really, really challenging. Like, hey guys, who wants to lend to me until December 31st of this year at this fixed interest rate, right? Instead, what you could actually do through the power of interest rates is you can start to separate pools of capital from how long they're being lent for. What I mean by that is in a traditional DeFi lending protocol, you're just borrowing money from some pool of capital, and then your interest rate is getting constantly reset, so you're exposed to that interest rate fluctuation. What you could do instead is you could borrow the capital from that pool of money, but instead of paying a variable interest rate to that pool, you could offset your interest rate risk to somebody else through the use of an interest rate swap. So if we go back to our example here, where you had a borrower who had, I'm going to delete this. You had a borrower who faced a smart contract, deposited ETH, and borrowed some DAI. He could actually use an interest rate swap to offset the variable interest rate that he's left with. So remember, at the end, he's going to have to pay some unknown amount of interest that he accrues. What he could do instead is use an interest rate swap. To swap his variable rate exposure to a fixed rate exposure. And that's literally all there is to it. So you have a guy who originally borrowed from, let's say, Compound, where the interest rate he accrues is some interest rate that changes every single block. And he can basically swap that variable rate into a fixed rate, right? So if he wants to pay a fixed rate, then he needs to get the variable rate from somebody else, and that somebody else will receive the fixed rate instead. So the use case for the borrower is somewhat clear, right? Like, effectively, you can use an interest rate swap as a borrower to convert your variable rate short-term loan from Compound into a fixed rate long-term loan. And it would open up the basically non-speculative use cases where rather than just literally constantly trading ETH and leveraging up on ETH, whatever the prevailing interest rate might happen to be, you might be able to use this for a small business loan, for some sort of mortgage, auto, or home, an education loan, or just other kind of more long-term use cases like capital assets. On the swap counterparty side, why would somebody be willing to pay a variable rate to receive a fixed interest rate? There's a few reasons. One could be purely speculative. If this person believes that interest rates are actually going to go down in the future, then he'd rather receive a fixed interest rate for a long period of time now and lock that in, rather than risk that as a lender, the amount of interest that he earns in the future might decline. He might also want to create a fixed income product. So if any of you have ever heard of things like bonds or notes, there are some investors, typically in crypto, who want a ton of volatility, but there's actually a lot of other investors who want as little volatility as possible, and they want to know what all of their coupons and cash flows are going to be. Like, they want to know, every 6 months I'm going to get a $1,000 check in the mail. That's the coupon that I receive. That's the fixed income that I receive. That's really important to me. And so through the use of interest rate swaps, actually, you can start to pave a road towards creating those fixed income products. And then additionally, as a lender, you might just say you'd rather lock in some fixed interest rate today rather than look at the volatility of that interest rate over time. So for example, like I personally, am a lender in some of these DeFi protocols, and I watch the interest rate on my loan fluctuate constantly. And it's not a ton of money, but from a personal level, I'd much rather just lock in and know what interest rate I'm going to get for the next, 6 months to a year, rather than watch it swing wildly back and forth. In particular, because if I'm not earning enough yield, I'd rather deploy my money elsewhere, right? Like, if interest rates could fluctuate between 1 and 20% in a given year, that's not as exciting to me as being able to just lock in 10% for the year and know that 10% is the hurdle that I have to hit for all my other investments. Okay, so I'm going to pause there really quickly for questions on any of this before I go into different types of interest rate swaps and how to do them on chain, just in case, especially for latecomers, if anybody had questions. Okay. Sorry, fire alarm.
We have concluded the testing on the fallout system within the OTC Fire Department for this evening. We now return to normal. May I have your attention, please? May I have your attention, please? We have concluded the testing of the building's fallout system within the OTC Fire Department for this evening. We now return the building to its normal settings. Thank you.
Sorry about that. Okay. So going into different blockchain implementations of interest rate swaps, first let's just introduce Alice and Bob. So, sorry? Okay. So Alice wants to, or actually, Bob here wants to pay a fixed rate. And Alice is willing to receive that fixed rate, and she'll pay Bob a variable rate. And this is all on some notional end. So talking in dollar terms, let's say it's $100. Alice might say, okay, on a $100 interest rate swap, I'm going to pay you a variable interest rate on that for the next 10 years, and you're going to pay me a fixed interest rate of 10% per year on that for the next 10 years. So what we can actually do is we can first visualize these cash flows, but it's literally that simple. It's an exchange of cash flows over time. So the first year, Bob pays Alice $10. The second year, another $10. The third year, another $10. I think you guys are getting the point. So there's 10 cash flows of $10 each that Bob owes to Alice. Alice, meanwhile, is paying this variable rate every year. So whatever the reference index is, let's say it's the average compound interest rate over each year for the next 10 years. So this first year, it might be, I don't know, 15%. So Alice owes Bob $15. The next year, maybe it's much lower. Maybe it's only 5, 8, and so on and so forth. It's fluctuating every year. But at its core, that's all an interest rate swap is. It's basically looking at a series of cash flows, some that are fixed, $10 per year, and others that change, whatever the annual compound rate might be. And then what an interest rate swap attempts to do is it attempts to basically look at the discounted cash flow of all of these individual cash flows, and it compares the two. And so if the market rate today is 10%, it's basically saying that 10%, $10 every year for the next 10 years, discounted back to today, is equivalent to variable interest rates over the next 10 years, discounted back to today. That's kind of in a classic interest rate swap, where what would actually happen is you'd have an NPV function. It's frankly a very complicated function in incorporating a bunch of different variables and a bunch of models for the shape of the interest rates curve over time, and different interest rates that you might want to use to discount your cash flows back to today. But what would happen is literally, in a classic interest rate swap, some third party valuation agent will look at Alice's variable cash flows that she has to pay and Bob's fixed cash flows that he has to pay, discount them back to today, again using some complicated models and math, and then say like, oh, okay, well, in today's value, Alice owes money to Bob. And then Alice and Bob would just exchange cash flows back and forth, not according to these numbers, but according to what the NPV of the trade is by looking at the discounted cash flow of these future numbers. It's really complicated. It's actually quite hard to do on-chain for a lot of different reasons. There's so much math here and so much modeling here that it would result in probably a bunch of really weird edge cases in your smart contract if you tried to do this on-chain, deterministically. So there's a couple of other ways that we could do this as well. The first and kind of most straightforward would be to fully fund all the cash flows. What I mean by that is, well, if Bob is supposed to owe 10% per year for 10 years on a $100 notional, that's $10 per year for 10 years, or $100. So you could ask Bob to put $100 into the smart contract right on day one. Now, Alice's side is a little bit harder because Alice is responsible for some variable payments. Who knows what they're going to be? They might be $100 over 10 years, they might only be 50, they might be 200. But Alice and Bob will together come to some agreement about what they think the maximum that variable interest rates will get to over 10 years, and she can collateralize that much. Let's just say they think that over the course of 10 years, they believe that compound interest rates are going to stay below 20%. So at most, they believe that Alice is going to owe $200 over the course of 10 years. That would be basically a fully funded interest rate swap where all possible future cash flows are deposited as collateral into a smart contract on day one. And then every time we observe what the actual compound rate was, we can release $10 over here and the actual compound rate over there. And this will happen, every year for the next 10 years as long as this swap is alive. It's entirely feasible today, actually, with pretty simple logic. And I think somebody had mentioned that they'd already written a prototype contract for this. The challenge with doing a fully funded swap here is that this is a lot of money. why would Alice and Bob put $300 into escrow basically for this interest rate swap when their original trade was only $100 notional? Like, effectively, what would happen if they were trying to do this is they would actually tie up so much capital trying to trade interest rates that the amount of capital they tie up here is actually multiples more than the amount of capital that they were trying to actually transfer risk on. So the value of that risk transfer for this interest rate swap might not be enough to justify putting this much collateralization into an interest rate swap contract. And this, again, like, I gave the example of like a 10-year swap to kind of demonstrate how capital intensive it could be if you tried to do fully funded interest rate swaps. Obviously, like, if we're talking about a 1 month tenor or even a 6 month tenor, maybe the calculus changes a little bit. But I think part of the reason why I feel passionate again about interest rate swaps is because they really unlock these longer term use cases that you're trying to get to. The business owners that are trying to borrow something for a couple of years, the mortgage, the student loans, those kinds of use cases really require longer tenor interest rate markets to exist to facilitate, versus if you're just trying to borrow some dollars for 3 months to get levered ETH exposure for the next 3 months, like, okay, fine, maybe fully collateralized will be fine for you. Or even just taking the risk on the variable interest rate will be fine for you. Okay, cool. So that was one way, fully capitalized on chain. Entirely possible, super, super, super capital intensive. A second way that we could look at doing interest rate swaps on chain is to do something called constant DV01. So DV01 stands for dollar value of 1 basis point. It's basically saying if Alice and Bob do this interest rate swap trade and interest rates move by 1 basis point, how much money is Alice or Bob going to make or lose? So effectively, it's like saying, well, today I believe that $10 per year for the next 10 years is kind of economically equivalent to this variable interest rate for the next 10 years. But if tomorrow the market moves and the market believes that the accurate interest rate for the next 10 years is actually 12% instead, so 200 basis points, how much money will Alice and Bob make or lose? That would be a DV01 metric. We can basically create a interest rate swap that assumes a constant DV01. So for example, it could assume that for every basis point that interest rates move, Alice will make or lose $1, right? So then what Alice and Bob need to decide is how many basis points do I think that interest rates can move at a time? Would interest rates move 1 basis point at a time? Or if interest rates were to move, would they move 1,000 basis points at a time? Their decision for how much they think interest rates are going to be able to move in any given period of time is a function of how quickly they think supply and demand for money is going to change. So if they think that sentiment in crypto is very volatile and overnight there could be, the number of people trying to borrow could double in size, or overnight the number of people trying to lend could double or halve in size, then they might say, oh, well then these crypto interest rates should be really, really volatile and could move by, 10% at a time. Or alternatively, they could say, no, actually, if we look at like actual dollar interest rates, like in the fiat dollar world, those interest rates move by 25 basis points at a time, typically. So there's really not, nearly as much volatility in those rates as there is in crypto rates. So they do some analysis. They try to understand like how quickly do rates move. If they move, do they gap or do they move smoothly and slowly over time? And they could say, okay, we did a trade where Alice and Bob make or lose $1 for every basis point that interest rates move. And we're going to agree that interest rates are only going to move by, let's say, 5 percentage points at a time. And if they move beyond 5 percentage points, I'm going to give up some of my upside. If they move within 5 percentage points, I'm going to expect you to top up your side to avoid default. So they could basically say, I think I said $1 per basis point. So if they think that it's going to be moving by 500 basis points at a time, then we'd want $500 from each of them. And that would be their margin requirement. So they have to each maintain $500 in the contract at all times, in order to avoid default. If interest rates move against them, the smart contract will automatically just move money according to the direction, like whose favor it's gone in. The expectation will be that your counterparty is going to top up on their margin in order to, if interest rates move against them, and you can withdraw some margin if interest rates move in your favor, or vice versa. This is a swap structure that exists kind of in the regular fiat world as well. This is actually reasonably easy to implement on chain because at the end of the day, it's just 2 fixed margin requirements with an expectation of topping up over time. So as long as you are able to observe what the market rate for interest rates is, it's actually quite easy to margin and remargin. The challenge with these constant DV01 swaps, though, is that real life loans are not constant DV01. Meaning, like, if I wanted to lend out money for 1 year and interest rates move tomorrow, I'm going to have a lot of exposure to that interest rate move. But if my loan is about to expire tomorrow, so the duration of my loan is very short, then actually I have very little exposure to changes in the interest rate. In fact, the interest rate could move a ton, but if my loan's expiring tomorrow, it really doesn't matter anymore. So constant DV01 swaps are useful kind of as a speculative interest rate product and for figuring out what building a market for figuring out where future interest rate expectations are going to be. But they're not very useful if you're just trying to do something really simple, like convert your variable rate loan on Compound into a fixed rate loan, because the DV01s actually don't match really well. So then we have the final way that I'm going to present for building an interest rate swap-like product on chain. And it's a little bit funky and kind of a bit of a hybrid. So basically you would have a smart contract acting as your escrow account. And you would say, okay, Bob, he's paying some fixed rate over the next 10 years. And we know exactly what that fixed rate is, so we know what each of these 10 cash flows are going to be, right? So we could ask Bob to pre-fund his side. So $10 a year for the next 10 years, that's $100. He can pre-fund that side. Alice, meanwhile, we don't know what her cash flows are going to be over the next 10 years. But once again, we can kind of try to establish an upper bound. What's kind of trippy and funky here is actually if Bob is trying to receive the variable rate for the next 10 years, and we think that the highest that it could go is, let's just say 20%, that's $200. Well, then Alice only needs to put in really at most $100 in order to make good on her obligation. Meaning, if she puts in $100 into the contract, there's $200 total. And then, if the variable interest rate goes up to 20%, then all of that $200 gets actually paid out to Bob. And if interest rates are anything less than 20%, whatever amount less gets paid back out to Alice. So already it's kind of like what the smart contract really needs to enforce is that over time, Bob will get his full $200 payment if we realize the worst outcome and variable rates spike to 20% and persist there every year for the next 10 years. So the role of this smart contract is to ensure that Bob is paid out if rates get to 20%. So how can we make sure then that Bob actually does get paid out if rates go up to 20%? You don't actually need to fully collateralize the full 10 years worth of cash flows in here straight from day one. What you could actually do instead is, once again, apply a bit of a volatility adjustment to this thing. You could say, well, I think that the value of these cash flows is only going to fluctuate by at most 20% at a time. Meaning really that like if the total payout, the total maximum payout that Bob could possibly get is $200, maybe Alice only needs to put in 20% of that from day one. And what you can actually do is just have an oracle feeding in the interest rate for this 10-year period of time. So let's say it's like August 1, 2019 to August 1, 2029. You could have an oracle feeding in the market expected interest rate between August 2019 and August 2029 in order to value the swap. And you can actually enforce that Alice only starts off by putting in some percentage of the total expected maximum payout, and then Alice just needs to top up over time. It's a lot more capital efficient, so instead of locking up, multiples more capital than the original trade that they were trying to transfer risk on, they could actually just put in a fraction of that. And the other cool thing that we can actually do with this hybrid approach is we can actually tokenize this whole thing. So that at the end of the day, what Bob is holding on to is a token that represents the expected variable interest rate over the next 10 years for the compound pool. The way that we would do this is basically by saying at the end of 10 years when the thing expires, a holder of the token could actually come in and redeem against the contract for all of the variable cash flows. And then it's just the responsibility of the contract over these 10 years to enforce that there is enough margin in here to pay off the token holder, where again, the token represents basically price exposure to the 10-year variable interest rate on compound. So it's a little bit funky. It's not a product that exists kind of in the regular fiat world. It's a little bit like a classic interest rate swap where one side has leverage and one side is fully funded, and then we tokenize the whole thing. So it's a little funky, and it's still kind of an early stage idea to figure out like where we would actually go to deploy it. But this is actually literally something that you could do with UMA today. So we literally have a smart contract template where you can feed in the price feed of whatever it is that you want, like this particular interest rate between these two dates. And then you can set some parameters around how much you expect this interest rate to actually be capable of moving over time. And then you just force one side of it, the fixed payments, to be 100% collateralized, and you allow the other side of it, these variable payments, to have some leverage, and then you can tokenize the whole thing. All of this put together creates, hopefully, the foundation for a really thriving interest rate swaps market or interest rate market on top of DeFi lending protocols that ultimately allow us to trade the price for borrowing and lending over time, and for us to efficiently transfer that risk between different counterparties, so that rather than just these lending pools being mostly used for short-term speculative use cases as they are today, they can unlock a number of longer-term non-speculative use cases in the future. And then what's also really cool about these interest rate swap things is if the parallel DeFi financial system ends up looking anything like the fiat financial system, interest rate swaps are probably the single largest derivative product that could possibly exist. So if you look at the fiat financial system, there's 500 some trillion dollars of total derivatives, and 90% of that is actually with interest rate swaps. And within blockchain, the killer use case so far has been within these lending protocols, all with short-term variable interest rates. We can use interest rate swaps to convert those short-term rates into long-term rates and more efficiently match off long-term borrowers with long-term lenders, and could potentially see that as being kind of like the killer derivatives use case as well. Okay, so I guess I've been talking for quite a while now. Any questions from the audience?
Hey, so I was trying to understand the hybrid model again. So if Bob puts down like $100 and Alice puts down $100, then how would Bob get his payout of $200 if the interest rate goes up to 20%? So technically, then Bob is paying for his half, or like, how does that work?
Well, yeah, actually, that is what's happening. So Bob is paying a 10% fixed rate, and he wants to receive a 20% or a variable rate. If that variable rate ends up being 20%, then he only receives the net 20 minus 10, with some discounted cash flow adjustments here and there.
So Bob is not like completely getting 20%.
Well, you can't get nothing for free, right? So what he said is, I will pay you the fixed in return for receiving the variable rate. So he's pre-committing to what that fixed is going to be. It's going to be 10%. And then he waits the 10 years to observe what the variable rate actually ends up being. Otherwise, if he just says, hey, I want to receive the variable rate, who's going to pay me? Nobody will do that.
Gotcha. That makes sense.
And then we also had a question from Alan. What happens if someone doesn't top up his side of the trade? So in this hybrid model, we actually had Bob be fully funded up front. So these fixed payments of 10% per year for 10 years add up to be $100, and he's already stuck all of that $100 into the smart contract. It's actually Alice's side that has the leverage. And so the challenge here would be if rates go up a lot and Alice doesn't top up her side. And so there's a few different ways to deal with it. The way that we've dealt with it as implemented right now is we basically say you have to pre-agree to the terms of trade, and you have to say, I don't believe that the variable interest rate is going to, the NPV of the trade is going to move by more than $40 at a time. If it stays within the $40, then Alice will be incentivized to top up so that she doesn't lose the rest of the money that she's already put down. And if it just gaps and instantaneously the NPV of the trade moves beyond that $40, then Bob actually might lose out on some of his upside. That's how we've implemented it right now. There's no kind of maintenance, keeper system. It just auto deleverages, and everybody loses everybody gets paid out what they were owed, but they lose their risk. There are other ways to implement it, which are kind of loosely on our roadmap, but not really prioritized for the next quarter, where you could introduce basically a keeper system that's kind of I'm going to use the word keeper loosely here, but you could introduce a system where if Alice is supposed to top up and she does not top up, you could have third-party people step in to take the role of Alice, and they can earn some reward for that paid out of Alice's margin account. Which is also probably a nice segue into kind of what's already built versus what's not quite built yet on our end. As I mentioned in the beginning, we provide two core pieces of infrastructure to the community. So the first piece is smart contract templates, and the second piece is a decentralized oracle. So basically this contract that would let you do this, that would let you create an ERC20 token that represents the variable interest rate of a DeFi lending protocol over time, that's already been created. We actually launched a mainnet our partners launched a mainnet product called US Stocks at the end of March using that template. We're basically retooling it, just making it a little bit more user-friendly for people who want to build and just spin up something really, really quickly. And we're going to be launching that for the general public at the end of August, beginning of September. They'll have a really nice UI where you can go through this whole flow to ultimately create your own custom token that can track anything with a price feed. In this case, this example that I gave, we put in the price feed of some interest rate between two periods of time. In practicality, this template could be used to create synthetic tokens that can track literally anything with a price, weather, S&P 500, Chinese RMB to dollar exchange rate, I don't know, the DAI versus Tether price, anything that you can really think of. We're going to be launching a couple more templates throughout the rest of this year. So this is really just kind of like the first one that we've been able to complete and get audited, but we're introducing new templates and a new framework for writing templates later this year as well. That'll be Q4. And then our Oracle mechanism that I mentioned is currently on the Kovan testnet being tested and really stress test. We're going to be pushing that to mainnet at the beginning of Q4 and testing that privately as well before a really larger mainnet launch.
Yeah, Allison. Super awesome and really interesting presentation. I have a question about one potential design that I just wanted to get your thoughts on. So is it possible that, let's say you have Bob paying out 10% yearly on a $100 notional, then is it possible to have Bob pay like collateral at the beginning of the year for just that year? Like, let's say pay $20, $30 of collateral on year one, and then every subsequent year paid $10 more. And if Bob doesn't pay, like lose all the additional collateral that was in that contract.
Yeah.
Does that make sense?
Yeah. Maybe I would think of it like a little bit differently, but I'm gonna draw it out on the board to make sure I understand you. So you could say, okay, there's 10 payments total, and we could ask both Alice and Bob to start off by collateralizing their next two payments. So Bob's next two payments are known. There are two payments of $10 each, so $20. Alice's payments are not yet known. They are two payments of some variable rate, where the variable rate could be 1% or it could be 20%. So because we live in this adversarial blockchain universe, you have to kind of collateralize to the upper bound. So maybe Alice collateralizes to two payments of $20 at the upper bound, and so $40 total. You could do this the challenge with doing this is figuring out if the economic incentives are actually aligned. So if the NPV of the swap could move by more than $20 in a single year, then Bob, starting the year with $20 in the contract, might see that he's better off walking away from the trade altogether rather than putting in next year's payment. And does that make sense?
Yeah.
Yeah. So you need some way first to value the swap and understand like what the volatility of the swap is in order to accurately margin it. And it's not depending on the volatility of the underlying interest rates. Just having like a static number, like the next 2 fixed interest payments, might not be enough to actually incentivize everyone to show up again the next year. But this is one way for sure that you could implement it.
Yeah, so is there any way, that's one thing I've been thinking about recently. I guess it's not really about interest rate swaps, but is there, I mean, it could be used in this specific case, but is there any way to like look at, I mean, without having a fully fledged derivatives market, to look at like implied volatility of these like underlying? So for example, right, you said you would need to have some kind of, I guess all of these rely on the assumption that interest rates are going to go to max 20%, right? And I guess if you could kind of price volatility or predict volatility better, then you could have a more accurate upper bound interest rate and a more accurate, margin requirement as well. And so I guess like, this is done in fiat through like, using Black-Scholes and predicting implied volatility. What are your thoughts on how this could be done in like a DeFi context?
So I think you can do a lot of the work actually off-chain, right? You could do that legwork in your own, like you could have your own personal view of what this volatility was, and if you can get someone else to agree with you on your view, you can get them to do a trade with you. The trick is just making sure that whatever you codify into the contract, or like you understand the boundaries and circumstances under which the terms of the contract are going to be honored. So if you entered into this interest rate swap, like hoping and intending for it to be a 10-year interest rate swap, but you don't actually like collateralize both sides correctly, then you might actually end up losing out on some of your upside or not getting the risk for the duration that you thought you were going to get it for.
Well, that makes sense. Yeah, I guess my question was also just like, how would you go about thinking about creating like volatility instruments themselves that can be like created freely on chain?
Yeah, so the cool thing again with derivatives is literally anything with a price you can create a market on. So let's say you want to trade the volatility of Google stock, right? Like, so the volatility of Google stock is like, I don't know, 15% annualized, and you think it's going to go up. You can actually create that already right now on chain using our technology. All you need is to find a price feed for the volatility of Google stock and then stick that into the price feed. And then you can create a market where one guy goes long the volatility of Google stock and another guy goes short the volatility of Google stock. And then you have this oracle saying like, here's the volatility of Google stock today, here it is tomorrow, so on and so forth. And then both sides will like margin their trades accordingly.
Yeah. No, yeah, that makes a lot of sense. I guess my question is more like, what about volatility of crypto assets? Like volatility of like, for example, interest rate swaps. I imagine that there's no like reliable price feed for that will tell you how compound is going to change in interest rates in the next few years.
You're saying that there isn't currently an oracle that will give you like the 10-year compound interest rate?
Yeah, volatility on the 10-year interest rate on compound. Yeah.
So it's a bit of a bootstrapping problem for a lot of these markets. If you have a really deep and liquid market, like you have a pretty deep and liquid market for Bitcoin now. So like, within some margin of error, people know what like the price of Bitcoin is. When things first got started, when everybody was just a miner at home, you just had Bitcoin. Bitcoin existed. the price of Bitcoin was like all over the place, like depending on who you were trading with, where they were physically located, whether they knew other people with Bitcoin or not, things like that. And so there's a bit of a bootstrapping problem with getting the price of things, right? And this is kind of the problem that our Oracle is really meant to solve, and to some extent, which is really tapping into the power of the crowd. So if you literally just ask one dude, what's the price of X, right? He can give you some answer. He could make it up, or he can manipulate it to fit his own needs. If instead you basically ask the crowd, and you give that crowd some economic incentive to attempt to answer truthfully, even when the truth might have some subjectivity, like the price of Bitcoin is like, you know, depending on which exchange, might be like within a dollar's range or something. And then you can actually generally usually get a pretty reasonable and fair price. So in the case of, you know, something like DeFi interest rates, like, yeah, you're right. Like, there's no market for interest rates today. If we create one, we'll have literally like created one. And then this observation of what the interest rate actually is going to come from whatever factors exist in the market, like where the market for these swaps is trading, what the current overnight borrowing rate is today, you know, what the chatter about raising the stability fee is or lowering the stability fee is. But over time, as depth grows in these markets, you can actually start to get more scientific about it. So instead of saying, like, I'm going to look at all these qualitative factors and then I'm going to tap the wisdom of the crowd, you could say, oh yeah, we'll just look at the interest rate swaps market, and like, you know, millions of dollars have traded today, and like they've all traded here, so like that's probably the price.
Cool, yeah. Interesting.
It looks like we had another question on chat. The person receiving variable rates will most likely be professional traders, and those paying fixed rates seem to be retail borrowers holding CDPs. What's the incentive for trader to create swaps if they're betting that variable rates will go up in the future? Okay. I guess actually, so maybe if you could clarify your question a little bit, actually, Vamsi. I'd love to understand kind of what you mean here. I can talk a little bit about kind of why I think there's natural two-way demand in the interest rate swaps market for people who want to pay a fixed rate or to receive a fixed rate.
Yeah.
I think like
basically to clarify.
Sorry,
just to clarify that question. So typically you said that a fixed rate would, like, there would be a premium, right? Let's say the variable rate today is 13%. Maybe the swap seller would the fixed rate would accept a fixed rate payment at 14. But if the swap seller anticipates the rates to go up, especially like what we've seen at Maker, like to 20%, and like, would there still be a market because they just wouldn't be able to sell a swap, right? Because they know that they would be on the losing end.
Yeah. Okay.
Accepting a fixed rate of 13, well, then they know that in the future, the variable rate that they'll pay out would go up to 20.
Right. Actually, I mean, the example that you gave exactly creates a market. So I'm going to move the screen over here for a clean whiteboard. So basically, is that legible? I don't know if you can actually see that or not. It might be too much glare. Sorry. Can you guys see that or no? Maybe not. Okay.
A little bit.
Please, sorry, let me get a new marker. One sec. So if we had a market for interest rates, then you'd be able to observe what the interest rate was for different periods of time. So you might observe like, oh, the market expected interest rate for 1 year is here. The market expected interest rate for 2 years is here. The market expected interest rate for 10 years is like up here, or you know, something like that. And then you can use all these data points to draw like a nice smooth curve for every single point in time what the market expects interest rates to be. So typically you have a number of kind of participants and incentives in all of this stuff. So you have borrowers who want to borrow short term, so they want variable rates, and same with lenders. And then you also have borrowers and lenders for long term. So a borrower for long term would be like somebody who wants to lock in a fixed interest rate on their car loan, for example. A lender for long term might be somebody who wants to lock in a fixed income. So, like buying bonds or something like that. And there's just basically different pools of people who want to trade and or who want to have exposure to interest rates for different periods of time. If you're just a trader, you probably don't really care very much about your exposure to interest rates at all. But again, if you're borrowing to finance your car loan or lending in order to get a fixed income, you want to get rid of all of your interest rate exposure. So the cool thing about this curve, if a market existed, is, if people are talking about Maker raising the stability fee, so we're here today, and the market believes that the Maker stability fee is going to go up, well, then the shape of the interest rate curve is going to reflect that. So it's going to reflect that the market expectation for interest rates between now and when they raise the rate is like down here. And then after the interest rate gets hiked, it's going to get priced in that rates are going to increase. And then they might price in more increases in the future, throughout the rest of the year. So you can actually then, as a trader, go and say, well, I think that they're going to raise the interest rate next week, but it looks like the market is only pricing in a 50% chance. Then you have a trade to do. You can pay the fixed rate and receive the variable rate because you believe that the stability fee is going to go up.
Awesome. I think that makes sense. Is that called the yield curve?
Yeah, exactly. That's a yield curve.
And does this normally change? Like, what interval does it change in the regular markets? Every day, every hour?
Yeah. So you have a yield. So if you had a market for interest rates, you'd be able to construct a yield curve. And this yield curve is every point on the yield curve, like every individual, customized point in interest rate swaps becomes a tradable thing. So basically, any given point can move up and down at any moment in time. In kind of financial markets, we call them first order and second order moves. So basically, there's some things that might impact the entire curve. So the whole curve might have started here, and then because something happened, the whole curve moves up or the whole curve moves down. That would actually probably be something like really dramatic, like moving to multi-collateral DAI, or something very like system-wide in terms of changes. How much of the fees accrue to MKR holders versus people who deposit into DSR. Those are like really big system-wide changes that probably affect the entire curve, like up and down. And then you have like a second order effect where instead of the entire curve moving up and down, you just get some points of the curve moving down or up. So that's called a flattening or a steepening of the curve. But literally these movements are happening all the time, and people are trading their views on what individual points on the curve are going to do. They're trading their views on what the difference between 2 points might do. Sometimes they'll even trade like these little weird butterflies in a really deep market.
Yeah, cool. I think that's super helpful. And for something like DAI, which is like really a dollar, is it can like the DAI's borrowing and lending activity on DAI, the yield curve for DAI, can that be determined by applying like some transformation to curves for dollars or lending activity on dollars in the real world, or will it be like completely different? Do you think like
Mm-hmm.
Uh,
That's another really, really good question. And maybe rather than addressing DAI, because DAI is pretty special, we could address USDC. So USDC, for those who aren't familiar, it's basically a fiat-backed coin issued by Circle, where every individual USD coin has one actual fiat dollar sitting in a US bank. And Circle is basically managing this whole create and redeem process where, when they get more dollars in their fiat bank, they create more USDC. And when somebody wants to redeem USDC for actual fiat dollars, they burn the USDC and they ship out or wire transfer the actual fiat dollars. If you look at USDC, you can literally redeem them for US dollars if you have a bank account and pass KYC with Circle. And yet, USDC borrowing rates and compound are, what are they now, like 9% or something? Whereas in the regular world, dollar funding costs are much lower than that. Like the dollar rate that you get for depositing dollars into a bank is you'd only earn like 2% on that or something. So why is it that in compound you can earn 9%, but at a regular bank you can only earn 2% when these are both ultimately fiat-backed dollars? And so the reason there, even though they're literally US dollars, one in digital form and then one in a bank deposit form, is because of a number of risks that are kind of inherent to our DeFi blockchain crypto space. So the first risk is just smart contract risk. Compound's great and it's been around for a while, but it hasn't been around as long as the regular banking system. And the risk of some code gone awry is just always possible. And so there's a risk premium demanded for that until people get more comfortable and until these systems kind of just exist for longer periods of time without any issues. The second reason is because of the use case. So right now, why are people borrowing dollars on Compound versus why are people borrowing dollars in the fiat world? Well, in crypto world, people are mostly borrowing dollars so that they can get extra hyper levered exposure on a super volatile asset. They're trading and they're speculating. In the regular world, people are borrowing dollars for a lot of things, including a lot of really productive and safe things. Really just boring activities. And in the regular world, in the fiat world, there's a lot of backstops as well to some of those activities. In the form of like bailouts or forgiveness programs in some form or the other. That doesn't exist on the blockchain. On the blockchain, all you have is some collateral and a loan. If you do experience a black swan event in the value of the collateral, then it's a lot of risk all at once to the stability of the entire system. So right now, if you look at Compound, for example, almost everybody who's borrowing in Compound is putting up ETH as collateral. Very few people are actually borrowing ETH. What that means is that they have this amazing liquidation process, but if the price of ETH was to experience just a catastrophic fall, they might not have enough ETH as collateral or enough liquidity in the DEXs for ETH collateral to make everybody whole on the USDC and DAI that they've lent off. There's a few other reasons in addition to that, but that's kind of why you might see and continue to see dollar interest rates in DeFi be different than dollar interest rates in the fiat world. I personally, though, kind of see that as an opportunity. If we literally had the same interest rates as the fiat world for dollar-based assets, then it's kind of boring. It's not going to attract new money. Anecdotally, kind of me personally, and then talking to some of my friends who are more on the safe investment as opposed to speculative asset side, the idea of being able to earn a 10% return on dollars for literally doing nothing more than parking dollars somewhere is way more is attractive and brings in a new type of crypto user into our system. Cool. We're a
Yeah.
bit over time, and so I really appreciate everybody who stuck with us this whole time. I hope it was useful. I think most of you have my email, but if not, it's just allison@umaproject.org. Feel free to follow up if you guys have any questions. I'd really love to keep the dialogue going and hear more about what you're interested in, and different ways that we can help. I love whiteboarding sessions. So whether you're using UMA infrastructure or you just want to nerd out about financial products, I'd love to nerd out with you. Yeah, stay in touch. Thanks, everyone.
Thank you so much. This was so
Thanks,
great.
Allison.
Thank you so much. We appreciate it.